Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Kevin Davitt, Head of Index Options Content at Nasdaq, to discuss what to watch post-options expiration. What are some of those market catalysts that are going to bring in the next wave of volatility? Kevin, it's great to see you as always. Welcome back to Trade Talks.
So good to see you too, Jill. Thanks for having me back.
You got it. And of course, standard expiration is here today. How has the market performed to this point, and what are the catalysts post-expiration?
That's a great question. I would characterize index performance year to date as mixed, following an outsized end of 2023 run, at least as far as the Nasdaq 100 is concerned. While it might not have felt like the index had its strongest performance since the late 90s last year. Now, that shift higher began in late October when the 10-year yields topped out around 5%. The advances continue, albeit at a more tepid pace this year. The chart that you have up on the screen now is a little bit busy, but I'd like to break it down. It plots year-to-date performance for a handful of market proxies. I'm going to go from the strongest to the weakest performers. Most of the markets I've highlighted are clustered around unchanged with a couple of exceptions. Now, I want to be clear that this data is through yesterday for compliance reasons. On the top, you have the Magnificent Seven since the start of the year. They are leading the way again, gaining about 75 basis points again year to date. The broader Nasdaq 100 higher by about 50 basis points. S&P is just slightly underwater. Dow is off by a little more than 1%. Now on the downside, you have the Russell 2000 lower by more than 5%, and China's large cap tracker that's off by more than 10%. I think that these two are arguably a continuation of trends that we saw for much of the past year, small caps and China underperforming. Now, today, the S&Ps, the Nasdaq 100, moved through those old highs following this morning's AM expiration. January expirations, like you mentioned, are typically large in terms of notional exposure that rolls off, and this one's no different. Now, the main reason that the Jan cycle index options is that those Jan cycle options are usually listed a few years ahead of maturity. So there's a whole lot of time for the cycle to build up open interest. And that kind of leads to my last point here. Sometimes these large expiration cycles can become catalyst for larger index ranges. So in some cases, the dealer community owns considerable gamma in the expiring cycle. That can act as a volatility suppressant. When that exposure rolls off at maturity, like we saw this morning, often you'll see realized volatility pick up. And I'm intrigued to see if that's going to be the case next week. I think the other catalysts are, of course, going to be Q4 earnings, and there's going to be a deluge of those in the next 2 weeks.
Can you tell us more about what's going on with NDX options specifically since we last spoke?
Yeah, so growth in NDX is a topic that I don't tire of highlighting. There's a variety of ways that we could evaluate those NDX changes. In the interest of time and your audience, I'm going to keep it brief. So on a full year basis, NDX average daily volumes grew by about 59% relative to the year prior. Giving that a little bit of context, because it was a really good year for index options, the broader index option marketplace grew by 31% last year. NDX open interest growth also significantly outpaced the growth of other major index options last year. Now, if January volumes are indicative, we are seeing a continuation of that trend. So year to date, compared to January of a year ago, volumes are up 87%. Now, the visual that you see shows monthly NDX volumes going back 5 years, so a considerable time frame. Growth of that magnitude, I don't believe can be attributed to any one or two things. We're observing it across customer type, from individuals and institutions, across geographies, and across the term structure. This doesn't, in my opinion, simply distill into a boom in short-dated index options use. More and more market participants, I think, are gravitating toward the exposure of NDX, and I believe that that trend will continue.
All right, and you had great growth for 2023. So what's the focus for your team in the new year?
Well, at a very basic level, we're going to continue to support the growth in Nasdaq's index options products any way we can. I think we pride ourselves on being responsive to our user base. We're going to be at a handful of events in the coming weeks where we're going to interact with the institutional community. We'll talk about use cases for the product, which is often very complementary if a firm is already active in index derivatives. We're going to do likewise for the European constituency as a part of an EQD event in early February, if any listeners are out there. From my perspective, the success of the product is, at least in some part, a function of the index performance, which is construction or methodology driven. And I think we are tasked with raising awareness in a world where there's constant competition for our attention. And we'd also like to challenge default behavior. In this case, the default is often the S&Ps, but the Nasdaq 100 kind of derivative ecosystem now rivals that incumbent. And market participants need to know about the liquidity profile in NDX because there's clearly a compelling opportunity for a lot of individuals, a lot of groups. We have average daily volumes near 9-year highs and more than 1 million NDX contracts trading monthly. Something we're doing is working, so we're going to keep at it. And I very much appreciate the opportunity to talk to you about it today.
All right. And we appreciate your insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.